In the recent months, USDe has risen to the top 5 stablecoins, having reached a market cap over $3 billion since its inception in November 2023. USDe is a synthetic dollar minted from the DeFi protocol Ethena. USDe and Ethena also attracted a slew of controversy due to its high yield offered to USDe stakers, briefly peaking above 100% at one point. Now, this understandably rang some alarm bells for those who witnessed the dramatic downfall and unwinding of Luna and its UST stablecoin, which offered 20% yield. Now, in this video, we'll explain what Ethena is, how it and its stablecoin USDe works, and how it's different from the ill-fated UST. Essentially, Ethena is a synthetic dollar protocol built on Ethereum, which allows for the issuance of USDe, a yield-bearing stablecoin. We'll get into the details of its peg and yield mechanisms later in the video, but first let's answer the question, why another stablecoin? Well, stablecoins are an incredibly important component of the DeFi ecosystem, providing stability in the volatile world of cryptocurrencies. USD-pegged stablecoins enable users to trade crypto and fiat currencies or hold cash without having to constantly enter and exit the crypto ecosystem altogether. You probably know that the stablecoin market is dominated by centralized players like Tether's USDT and Circle's USDC, which are backed by USD fiat reserves and cash equivalents. Now, this heavy reliance on centralized stablecoins remains to be the elephant in the room for the supposedly decentralized finance ecosystem. While there already exist protocols like MakerDAO, which attempt to provide a more decentralized stablecoin alternative, the fact is that their reliance on centralized stablecoins like USDC and more recently RWAs make them fall short of the decentralized ideal. Like blockchains, all stablecoins also face their own trilemma of decentralization, stability, and capital efficiency. Now, DAI started out more decentralized when it only took crypto-native assets like ETH as collateral, but its capital efficiency, aka scalability, was hindered due to the need for over-collateralization, which was what ensured stability. Luna's UST was rather decentralized and undoubtedly scalable, as showcased by its growth to almost a 20 billion market cap, but we all know how stable it ultimately was. As an effort to address the pain point of DeFi, Ethena set out to create a stablecoin that is non-reliant on the TradFi system. USDe is backed one-to-one by delta-neutral crypto-native collateral, which currently consists of ETH liquid stake tokens like STETH, wrapped BETH, and BETH, and also Bitcoin. Delta's most common or general meaning is the difference or change in something. Delta neutrality, thus, is a strategy that seeks to eliminate the downside risk of holding an asset, typically done by taking a counter position using derivatives such as futures and options to offset any losses incurred by the asset declining in value. As a simple example, if you held 1 Bitcoin on spot and simultaneously shorted the notional value of 1 Bitcoin on the futures market, you have essentially delta hedged your position, achieving delta neutrality, as the gains on one side would offset the losses of the other and vice versa. This is basically what Ethena does to crypto assets deposited into its protocol. As soon as collateral is deposited and an equivalent dollar value of USDe is minted, Ethena would have to offset the exposure of holding these assets by shorting their same amount on the futures market. As the gains and losses from both sides cancel each other out when price fluctuates, this ensures its collateral remains stable in USD terms and maintains a 1-to-1 ratio to the USDe minted. While delta neutrality is not a new concept in finance, Ethena is the first to implement it to maintain the US dollar peg of a stablecoin. Ethena also calls USDe the internet bond because users can earn yield by staking USDe. While currently only whitelisted addresses can participate in the minting of new USDe, regular users can already participate in earning yield by buying USDe through Ethena or other DEXs or SEXs which support it, then staking it on Ethena to receive USDe. At time of shooting, this yield stood around 17%. So where does the yield come from? Ethena earns yield in two ways: positive funding rates and ETH staking rewards. ETH staking works as you'd expect. Since a portion of USDe's crypto collateral consists of liquid staked ETH tokens, these accrue yield for its holders in the form of newly issued ETH, additional fees paid by users, and also MEV capture. Funding rates, on the other hand, is a mechanism that enables perpetual contracts to closely track the price of their underlying asset. If the price of the perpetual contract is higher than the spot price, the funding rate would be positive, meaning that traders going long have to pay a small fee to traders going short. This incentivizes short positions, which can help pull the contract price down a little. The reverse is true when funding rate is negative, where shorts pay longs when the contract price is lower than the spot price. The key takeaway is that in cases where funding rate is positive, traders going long will have to pay traders who are going short and vice versa. As explained earlier, Ethena hedges its crypto holdings by shorting its equivalent value on perpetual contracts, which generates yield through the positive funding rate. By capturing value from staked ETH and positive funding rates from short hedges, Ethena presents the internet bond as an opportunity to capture yield from two sustainable and external sources. Now, let's look at some of the risks with Ethena's model and how they are being addressed. As USDe relies on positive funding rates from delta hedging to accrue yield, a key concern presents itself during periods of negative funding rates, which occurs when demand for long positions decline significantly. Remember that when funding rates are negative, it means that Ethena would have to pay the funding rate in order to hold on to its short positions. According to Ethena's head of research, Connor Ryder, there has historically been more demand for long exposure on Bitcoin and Ethereum, resulting in positive funding rates for over 80% of days in the last 3 years. In the 20% of the days when funding rates were negative, only 11% of those were costly enough to eat into the ETH staking yield. Ryder further comments that these periods happened only briefly and should act as an incentive for users to redeem USDe. However, the data thus far does not take into account of Ethena's open short interest on the futures market. Due to Ethena's pegging and yield accruing mechanics, its large-scale shorting in itself could cause more days with negative funding rates. To mitigate this risk, Ethena has a reserve fund to pay for periods of negative funding rate and act as a bidder of last resort for USDe. Supposedly, this protects USDe holders from negative protocol yield. Whether or not this fund is enough to cover the risk of negative funding rate, on-chain data provider CryptoQuant pointed out that Ethena's sustainability ultimately depends on its keep rate, which is the portion of revenue that Ethena allocates to the reserve fund. Studying historical periods of prolonged negative funding rates during Ethereum's post-merge and FTX's collapse, CryptoQuant came to the conclusion that Ethena will have to maintain a keep rate of above 32% to grow the reserve fund large enough to withstand periods of extremely negative funding rates during a bear market. Ryder further adds that a reserve fund of 20 million for every 1 billion of USDe supply should survive almost all bearish scenarios in their research. This all means it's prudent for users to keep a close eye on Ethena's reserve fund just in case. It's also worth noting that Ryder mentioned that in a worst-case scenario of prolonged negative funding rates, USDe will simply depeg and bleed out slowly until funding rates turn back positive, rather than a dramatic collapse of the likes that we've seen with UST. Besides funding rate risk, there is also collateral, exchange, and custodial risk. The problem is that LSTs as collateral is that they might not always be worth exactly the same amount of regular ETH. Ethena minimizes this risk by using LSTs for only 10% of its collateral. As for exchange risk, Ethena relies on centralized exchanges such as Binance, Bybit, BitGet, Deribit, and OKX to execute their short hedges on the futures market, and thus exchange failure becomes a risk for Ethena. To mitigate this, Ethena utilizes multiple reputed sexes for its shorts and never deposits collateral to exchanges, opting to use off-exchange settlement, aka OES providers, for custody and settlement instead. OES providers are responsible for the custody of the assets that back the value of USDe, while allowing Ethena to execute the necessary operations on exchanges through them. To mitigate custodial risk arising from the reliance on OESs, Ethena engages with multiple OES providers with any single exchange at a given moment. It's worth noting that this does not imply counterparty risk has simply been shifted from the exchange to the OES. This is because funds held by the OES are legally bankruptcy remote, meaning that if an OES defaults, assets in their custody cannot be liquidated to repay creditors. The chosen OES providers are also non-US based, which Ethena believes will mitigate regulatory risk. Well, there's a lot to cover with Ethena that we couldn't manage in this video, but that's all for today's video for now. Now that you understand USDe is entirely different from the doomed UST, do you think it will work in the long run and live through bear markets? Well, let us know your thoughts down in the comments. If you found this video to be helpful, give us a like, subscribe for more future videos, and I'll see you in the next one. Bye.